going to have a whole lot of money coming in and into the sector.
This is like trying to siphon Hoover Dam through a garden hose.
What if the auto debit for everyone's retirement accounts started allocating on a weekly, monthly basis? What if the 70 to 80 trillion dollars of wealth that baby boomers are in possession of starts to rotate into that? There's a lot of money out there. Welcome to Boolean Standard, where we're all doing better together. This is our goal. We want everyone to be in as much human flourishing as possible. We're here to talk about the death of the 60-40 portfolio. We've been inside of the narrative in the precious metals community forever. You know, there's always the narrative that, you know, fiat currencies are burning up, and that is true, and they always have. And it's like, well, when will there be the signal that we're in some trouble? You know, everyone has their own ideas about when, and that when is now. It's happening right now. So, Kyle, we're going to talk today about what the big news is, the big news around the traditional investment portfolio, and how for those who have gotten the signal early for the last couple of years and participated in allocating a portion of their portfolio to gold or precious metals, have enjoyed a really nice run up, a really nice add in value, and there's seemingly the setup for a continued run for at least the next, year, 2 years, and then long term into the next decade. So go ahead, Kyle. Tell us what we're gonna talk about today.
Yeah, today we're talking about some groundbreaking news that we would describe as groundbreaking as it relates to gold and gold's role as a monetary asset, as an alternative investment class kind of asset. And basically its role for the past 45, 50 years and how it's changing dramatically in lifetime. Let's start off, Charlie, by saying, let's talk about the 60-40 portfolio. Where did this concept come from? Who created it? It was created by a gentleman named Harry Markowitz. He is this really old guy. He passed away recently. He's one of the fathers of modern finance. He actually lived in Mission Beach.
Oh, really?
And interestingly, my college mentor met him in person. He met him at a restaurant in Pacific Beach one day. But fascinating guy.
Pacific Beach or Mission Beach?
Pacific Beach.
So Pacific Beach is in San Diego.
Yep.
And that's where Kyle and I reside.
So Harry Markowitz created this thing called the efficient frontier. Which is a finance kind of thing on, there's a capital market line, capital allocation line. He created this little graph thing, just totally high level overview of this. It's called the Markowitz bullet. And it's a finance thing. But the 60-40 portfolio really for the past 50 years or so has been, no pun intended, Charlie, the gold standard of investment allocation. There was very little to no room at all in this allocation for alternative investments like gold or real estate or anything other than just stocks and bonds. Stocks, of course, provided growth and upside. Bonds provided value and stability. They pay a coupon, they pay a yield. You can get a guaranteed return. If you're investing in U.S. Treasuries, this is known as the risk-free rate. Why is it risk-free? Because if anything ever happened to the U.S. government and its obligations to repay its debt, it can just counterfeit money out of thin air. Pretty riskless.
There's also a principal balance that doesn't, the nominal value of the bond doesn't go down. You can have, erosion of the nominal value of the bond through inflation. But ultimately, when that bond matures, you get the face value of the bond back. So that's one of the things to distinguish why some people would say it's risk-free.
Let's talk about, before we start off with the big ticket item that came out recently.
Just share the big ticket item. Let's go.
Well, the big ticket item, of course, is the CIO of Morgan Stanley, a very big bank, very big financial services company, behemoth, recently came out and said, hey, the traditional 60-40 portfolio, that might be going the way of the dinosaur. Instead, maybe we should be talking about the 60-20-20 portfolio. Of course, Charlie, this means that 60% allocation to stocks or equities, 20% allocation to bonds, and oh yeah, that's right, 20% allocation to alternative investments.
It's a big jump right into 20%.
It's a big jump. This is something that, from our point of view, has made sense for years, but it's just not mainstream. There's this really smart guy who we look up to. His name is Rick Rule. He would say people don't know how to spell gold, even though it's a 4-letter word. People are starting to realize how to spell gold this year. We're seeing a fundamental change in real time for how people allocate to alternative investments, including gold.
And when we say people, what do we mean? Well, we mean like the broader swath of the general investment community.
That's right.
One of the things that I heard recently, someone say is, why are money managers not allocating towards precious metals? And one comment was, well, because if something goes wrong and they're invested in bonds, then they don't get fired. And if they're allocating outside of the normal mainstream structures of agreed upon portfolio management, then they're going to continue on because they're all kind of in the same boat. So this is a really significant change that the structure, the normalizing of investing in precious metals, gold, maybe we'll parlay that out in all precious metals, and then, the mining sector as well. So now it's becoming a normal structure in institutional portfolio management. So what does that mean? Ultimately, it means that we're going to have a whole lot of money coming in and into the sector, and what was the saying? It's like trying to force a bowling ball through a garden hose. The amount of liquidity that tries to enter into the sector, and for all of us that have the slightest idea of the laws of supply and demand, we can allow our imaginations to run wild, or we could go back and look in history and see what has happened in prior cycles, which is very fascinating.
What you're talking about is the Doug Casey quote, where he suggests that when the mainstream generalist investor or retail investor starts to come into specifically the gold, silver, and other precious metals mining stocks as a whole, there isn't enough market capitalization to contain the flow of liquidity into the sector. And so the sector re-rates. And this is like trying to siphon Hoover Dam through a garden hose. And then it's when you think about this, plugging a freaking hose into Hoover Dam. It's like, yeah, I'm going to siphon Hoover Dam through the garden. No, that thing's going to blow right off and just evaporate immediately.
Yeah.
So let's talk for a moment about this fundamental shift that even we at Bullion Standard can see in live time. Charlie, we've been in this business for 15 years. In my mind, what's happening right now is historic. There is a clear and obvious rotation into this archaic pet rock alternative asset class that everybody just bashed for so long. RIAs never mentioned it. Investment professionals never mentioned it. I want to talk about why that was, but first I want to talk about this really interesting statistic, and it comes from the commodities trade desk at JP Morgan. It's a little bit dated, but we have information that leads us to believe it's still relevant, and I'll speak why that is. According to the commodities trade desk at JP Morgan, they believe the 40-year mean allocation to precious metals and precious metals related securities, bullion, physical trusts, ETFs, the mining sector, the total allocation relative to all U.S. savings and investment assets is about 2%. Right now, it is less than 1%. This statistic is a bit dated, but
So it might be 1.2% now.
we've confirmed as recently as February when we talked to a research house known as CPM Group. Our audience might be familiar with them. A little bit, a little bit controversial there. If you are a stacker, you know who CPM Group is. But we can say with confidence the allocation is probably around 1% as of earlier this year in 2025. Has it crept up a little bit since then? Probably. Is it 2%? Probably not. But that's really important, Charlie, because it gives this picture we can look at and say, what if? What if things get so chaotic out there that we revert back to mean 2%? And then I want to take it a step further. What if we overshoot the mean? What if things got so interesting out there that university endowments, sovereign wealth funds, the largest insurance companies in the world, all took a posture that, hey, we might want to be allocating 20% to gold or 20% to gold and some other alternative asset class?
What if the auto debit for everyone's retirement accounts started allocating on a weekly, monthly basis? What kind of floor or stability in the price would that create? What if the 70 to 80 trillion dollars of wealth that baby boomers are in possession of starts to rotate into that? There's a lot of money out there, and there's this the precious metals sector is infinitesimal compared to the broader investment markets.
It's infinitesimally small, Charlie, as you suggest. So my thought here is that what the CIO of Morgan Stanley just came out and said, it's like the shot heard around the world that there's
Little Paul Revere's ride. This is the Morgan Stanley Revere ride.
Yes, the Morgan Stanley Revere, and it to me, I'm taking it as like I'm so jittery about it because it's like, what did you just say? Really? We're talking about this archaic thing, and you're thinking it has a need to be as much as 20% in somebody's portfolio? Okay.
Well, it's evidence too of the generational shift. We're in the cycle. We're in the cycle of the fourth turning. We're in the cycle of good times equal weak men equal bad times equal strong men. So where are we at in that cycle? Well, we're in the cycle where there's cultural shift, there's political shift, there's institutional change, there's institutional transformations. So yeah, there's transformations happening right now, and it all follows that same cycle of human development. We've got the cultural, political, and they say it's around a 20 to 25 year cycle. Interesting that as a human we only truly mature, like physically our brains only finish developing around that 25 to 27 year range, maybe a little plus or minus. So these cycles all make perfect sense. They line up with our humanity.
Speaking of cycles, Charlie, why was the 60-40 portfolio untouchable for all this time? Let's talk about the fact that maybe one of the reasons why is that for the past 40-something years now, we've had nothing but continually declining interest rates. Interest rates, of course, peaked in the late 70s, early 80s when Paul Volcker stepped in and the country as a whole collectively said, hey, we got to stop stealing from our grandchildren's future. We got to fix this inflation thing. Let's pull this lever. Let's take interest rates up to, my gosh, 30-year bond, 15%. Could you imagine locking in a 30-year U.S. Treasury for 15%? And then just from there, for the next 40-something years, 45-degree line straight down, of course, with some squiggles along the way, but continually declining interest rates were a big part of that, philosophy of the 60-40 portfolio. And it was kind of like the U.S. Treasury is reliable, it's a safe haven, and it's all this stuff. With this first shot being fired around the world now, that's kind of in jeopardy. And so there's all kinds of sporadic and unimaginable consequences this could have if 20% of U.S. Treasuries were converted into gold.
Well, it's been in jeopardy forever. Like this is just a cycle, and so this is an indicator that we are moving forward in the cycle.
Right.
That's a better way to say it, I think.
Recall too that some cracks had started to develop in the system in 2022 when both bonds and stocks fell. Bonds became just like a stock. Bonds should have typically been the flight to safety trade, but instead, for the first time going back to the 1930s, bonds and stocks fell together. Very interesting kind of thing that was not expected. And I remember a few years ago this being like a very interesting point of discussion. And so, that's just kind of one other reason that would be fueling this shift.
Well, we also had people have been talking about the bond vigilantes, for as long as I've been paying attention, to gold and precious metals for my own personal portfolio. And, we've had another shot heard around the world when we had the tariff turmoils and we had our political revolution start to happen with the Trump administration and tariffs. And then, the bond market said, no, I don't think we're going to allow for this. We're going to require a higher premium for this destabilizing process that was about to take place with Doge and, trying to return to, more responsible fiscal stance with our debts and deficits. And so that's out the window now. So, our debts and deficits are probably worse. And so we're going to try and grow our way out of this conundrum that we're in. And that setup is there. So they say, but like look back through history, even if we start to grow our way out of this thing, are our political leaders willing to, jeopardize their power and control and reelection? I don't think so. This is a normal human behavior. People will pull the levers, including everyone. No one wants to go backwards. Everyone is always looking for the next. They're always looking for more. And so this is a very normal human behavior. And so anyone that's in power that's going to, say, hey, I'm going to take on a responsible position here. I'm going to vote for lowering the debt, pulling back on the spending. It is a suicide decision politically. And so we could ask ourselves this question. And when the answer becomes yes, then we could say, okay, now we're in a bit of a shift back. But we've got years to go. If the answer to the question, are our political leaders willing to pull the political suicide lever? When that starts to happen, then we would want to reassess, where we're heading. But right now, that is the answer to that question is absolutely no.
We can't underscore how radical this new kind of philosophy out there that's being suggested when we talk about a 20% allocation to alternative investments like gold. This isn't. We could say something like that's no longer a hedge. It's like a pillar. It's a new paradigm almost.
It is a new pillar,
and
absolutely.
So we'll just take a couple minutes to talk about what this means for gold investors. Think about the capital inflow that would happen. A move from sub 2% allocation to this investment class, taking that up to some number like 5%, 10%. My gosh, 20%.
It would significant.
It would be a complete reshift. Think about ETFs. Think about physical trusts. Think about the mining sector. If the margin of a gold miner stays around what it is now, and gold were to go up to $5, $7, $10, $15, $20,000 per ounce, that would become arguably the most attractive cash printing business on the face of the planet.
Well, you have to understand with gold, the consequences of a $20,000 gold price in the broader economy also mean that the miners are going to have, some destabilizing events, and like inflation's going to be adding to their cost of maintaining and operating their mines, and so there's a lot of different things to think about there. We don't want a $20,000 gold price. That would mean we're really outside of what our purpose is here of human flourishing. We don't want that.
One of the things a lot of people out there, including us, would say, Charlie, is that gold is not an investment in the sense like stocks or more speculative assets are. Gold is gold is a form of savings, and it's also simultaneously insurance policy. We could think about this as a home insurance policy. If you own a home, you'd buy a home insurance policy, and you don't hope that your house burns down. But if your house does burn down, you're very thankful that you have the insurance, so you're not left empty-handed. That's exactly the role of gold. And so we own a little bit of it.
It could also be said that gold will, be a overpaying insurance policy.
Right. Is 20% too much? Is it too little? There's some people out there who some people would say, "Oh, I have 50% allocation to precious metals."
Well, again, it depends on your own personal goals. You have to take a look for yourself and say, now that I've educated myself more, and now that I know more, where am I at? Where do I want to be? And, what's the structure at which I'm going to get there?
So in closing, Charlie, I think it's fair to say that the 60/40 portfolio, I don't think it's dead, but it's definitely dying.
It's in transformation.
It's in transformation.
It's in paradigm shift. It's in cultural shift. We have the shifts happening always. The significant ones happen pretty regularly on certain cycles, and there's lots of indicators as to where we're at inside of those shifts. This is one of those indicators.
Right. So, we're going to keep making content. We'll keep everybody updated kind of how we see it out there in the market. But as a 15-year participant in this market, Charlie, I have never seen this before. This is something that's totally new, and I only see it as growing, and I see it as something that has the high likelihood to overshoot this 2% 40-year mean allocation to this asset class, and overshoot wildly higher. And if that's the case, we're all still really early to this thing, and
we'll keep our eyes on the indicators. We'll see how this thing plays out. It seems like, the old saying of history may not repeat exactly, but it sure rhymes.
That's right. It rhymes, but does not repeat exactly. So
take the cards as they're dealt and allocate appropriately.
Ladies and gentlemen, thank you for joining us here again at Bullion Standard. We hope you got a little bit of value out of this video. If you did, we'd appreciate it if you would like, comment, and subscribe. If you have a comment, please leave it below. We'll absolutely respond to it. We'd love to hear from you. Charlie, do you have any departing thoughts that you'd like to share?
Yeah, go to bullionstandard.com, check out the pro membership. If you see some value for yourself in not paying retail markups, that's something you could get value from. And if you get value and you want to share it with other people, you could take a look at becoming an affiliate and getting a little extra value from Bullion Standard.
Thank you for joining us at Bullion Standard, where every ounce matters, and so does every insight. Until next time, Charlie.